Hello everyone, this is Kevin Zhao, your finance professor at MTSU. We are in the fourth week of the study. During this week, you have a lot of work to do. First of all, we will cover three chapters: earnings multiples, book value multiples, and sales related multiples. They are in chapter 18, chapter 19, and chapter 20. That's the chapter that we are going to cover this week. And second, I want to remind you that the second exam is due next week. It's time for you to work really hard on those problems, and please submit your solutions to D2L before the deadline. So that's second exam, and the second exam is also take-home exam. There will be 10 questions, and all questions from end of the chapter problems and questions. They are typically even number questions. Right? So if you haven't done anything yet, I think it's time for you to work really hard on those questions. Realistically, you would expect to spend more time on second exam than the first one because you will come across a lot of problems that require you to spend a significant amount of time to solve them. Typically, a valuation related problem will ask you to put in at least like 30-40 minutes on every one of them. So don't wait until the deadline to work on your second exam, and I want you to fix those problems gradually. Last week we covered cash flow related valuation models, free cash flow to firm, free cash flow to equity, and the dividend discounting model. So I expect you already completed those problems, and this week I want you to fix those valuation multiple related problems and questions. Right? So that's second exam, and the third assignment is related to your valuation project. As I said, you just cannot complete this valuation project in just a couple days. You have to do this step by step. During the first 2 weeks, you get access to company information, especially 10Q report. So you will have a detailed understanding on what company is doing, what business they are doing, what is the challenge they are facing, what is opportunity they might have in the near future. For this week, I assume you already completed your work on those parameters, valuation parameters, especially the parameters associated with estimated cost of equity and weighted average cost of capital. And this week, I want you guys to utilize Capital IQ to conduct financial analysis of the company that you're going to analyze. And many of you may ask, what should I do for this financial analysis? First of all, you should have your account ready for capitaliq.com. If you're an MTSU student, you can use your MTSU email address to sign up an account to get access to this great financial information database. And then you look at the company that you're analyzing, and to get access to all the financial information about the company. I will show you some details on how you use this capitaliq.com in another video. But here I want you to know that to do a successful financial analysis, you need to do four different types of work. The first one is historical comparison. You can download historical numbers of financial information about any given companies on annual basis or on quarterly basis, and I want you to look at what happened in the company during the last 5 to 10 years. Typically 5 years. If you can go as far as 10 years or 7 years, that will be great. So once you have those important financial matrix during the last 5 to 10 years, then you can conduct so-called historical comparison. And from historical comparison, I want you to focus on its growth rate. During the last 7 or 10 years. If it's 10 years, that shows you the growth rates during the most recent business cycle. So that is historical analysis. historical comparison. What do you compare? You do not compare everything on three financial statements because there's so many items that you need to compare, but you pick those most important things such as revenue, EBITDA, EBIT, net income, depreciation, amortization. Those are very important items in those financial statements. Total assets, working capital, so on and so forth, and some financial ratios such as ROE, ROA, profit margin, and that is a historical comparison. Typically, you wanted to look at all five categories of financial ratios: operating performance ratios, leverage ratios, operating performance ratio, leverage ratio, liquidity ratio, so on and so forth. But the main focus is on the operating performance ratio, such as ROA, ROE, profit margin, so on and so forth. Right? So that is a historical comparison. And the second work that you needed to conduct for financial analysis is so-called peer comparison or horizontal comparison. You compare this company with its main competitors to see what's the difference in those important financial ratios, so you can see if this company is a strong competitor or weak competitor in its industry. Right? So that is a peer comparison. And a peer comparison can reveal the strength and weakness of companies' business operation, and that is very important. And you need to highlight the competitive advantage of the company that you are analyzing. So that is a peer comparison. And peer comparison is hard because not only you need to collecting those financial information, but also you need to look at the trend in certain industry. My suggestion is to look at the surveys, the industry surveys, which might be available in this capitaliq.com. So you can learn a lot about how certain business operating in a given industry. You have to have some business perspectives to do this so-called peer comparison, right? And third work when you do financial analysis is to look at the most recent quarterly report or most recent annual report if it's available to see what's the most recent trend that you can find in a given company when analyzing those financial ratios. And typically it's a quarterly report, thank you report that you can find for any given company to see how the financial ratios changes. Compare this quarter versus the last quarter or the same quarter during the last year to see if there any improvement the company is getting for their business operation. So that is the most recent quarterly financial ratio analysis. And the fourth work, the last one is to look at what will happen in the near future for this company. I mean, it hasn't happened yet. I mean, when you look at the financial statements, all of them are outdated because it only reflects information happened during the past fiscal year or past quarters. And the last work is forward-looking work, and you wanted to look at what may happen for this company in the future quarters or in future years. I mean, you cannot go as far as 2 years. That's typically what people could do. They can forecast what will happen in the next several quarters up to 2 years. If you wanted to estimate what will happen in 5-10 years, of course you can do that, but it's less likely you can get it right. And also you wanted to look at what management are saying about their future quarters and future year. So in the 10K report and 10Q report, you really wanted to look at those forward-looking estimates. And another way for you to get those forward-looking estimates is to look at the earnings release transcript from a company's shareholders meeting. And in those meetings, CEOs, CFOs will meet financial analysts from major investment banks, and there will be very interesting conversation, which will reveal what management thinking about their future quarters or future years regarding their operating performances. And we call that as the management guideline. Management guideline. I want you to look at those management guidelines and to see what is the realistic expectation regarding what will happen in future quarter and future year, because that is critical for you to make estimates for those cash flows or even the estimation of parameters. So that's financial analysis that I want you to do during this week for your valuation project. And next week, once you have financial analysis ready and the parameter worked down, then it's time for you to put everything into your valuation model. And the next week, I typically want you to use multiple methods to come up with stock valuation, and you should do both cash flow based model and valuation multiple based models. And two alternative model, that is the minimum that you could do. And ideally, I want you to use free cash flow to the firm model for cash flow based model, and P ratio plus other ratios, at least 2 or 3 ratios, 2 or 3 valuation multiples to assist your valuation as well. So you should use multiple methods for your valuation. So next week, you're going to put everything into your valuation model to come up with the estimation of stock price. And in the 6th week, I expect you to submit a draft of your stock research, and you can submit it to me so I can look at it, give you some recommendation, but it's not required. So yeah, the 6th week, I expect you guys to have a project draft ready, and during the last week, it's time for you to present your project during the class. For the last week, how do you submit your final valuation project? I expect you to submit 3 files to D2L. The first one is your written report of your valuation project, and the second one is your Excel spreadsheets that you use to develop those valuation parameters, financial analysis, and valuation models, so on and so forth. That's Excel spreadsheet. And the last one would be your presentation file, ideally PPT for you to present your project to the class. And expect each team to spend about 20 minutes to present all the detail that you wanted to demonstrate for your valuation project during the class. So that's valuation project. So a lot of work to do this week, 3 chapters to cover. You have second exam due next week, as well as a lot of work that you need to complete for your valuation project. I'm here to help all of you guys to achieve your academic success in this class. If you have any questions, don't hesitate to send me emails or visit my office during my office hours. Once again, my office hours on Tuesday and Thursdays mornings. If you needed to meet me other time, just send me an email. We can make that happen as well. Okay, now let's take a look at chapter 18, earnings multiple. Previously, we learned cash flow based models, and those are so-called absolute valuation models, and those absolute valuation models will give you a stock price estimate in US dollars. Now let's take a look at another system of stock valuation, that is relative valuation. And the relative valuation doesn't give you absolute value of a stock. Instead, it gives you a standardized stock price. or kind of ratio, right? It's a stock price per unit of something. For example, this earnings multiple is so-called a PE ratio. It shows you stock price per unit of earnings. And in the next chapter, we will learn about PB ratio. Then the PB ratio is the stock price per unit of its book value of the equity. And in the third chapter, chapter 20, we will learn about a PS ratio or revenue-based ratio. That's the stock price per unit of sales. So relative valuation only tells us about the ratio or standardized stock value. So in essence, in relative valuation, the value of assets is compared to the values assessed by the market for similar companies. And to do the relative valuation, we needed to first of all identify comparable assets and obtain market value for those assets. So what are those assets? Those are competitors of the company that you are analyzing. And we look at the industry level information and collect the market value of those competitors. That's the first step. And then you convert the market value into standardized value. Because when you compare company A versus company B, company A has stock price of $20, company B has $10. Which one has relatively high or low stock price? You cannot say anything about that because different companies have different number of shares outstanding. They have different size. They have different growth. They have different earnings. They have different sales. So we wanted to standardize the value of the stock to see which one is relatively cheap or relatively expensive. And the last step is to compare the standardized value, also called the valuation multiple, for companies being analyzed, and controlling for any differences between companies that might affect the multiple to see if certain stock is undervalued or overvalued. Relative valuation is very popular. Almost 85% of equity research reports are based upon a multiple or comparables. And those multiples are typically PE ratio, PB ratio, price to cash flow ratio, or maybe EV to EBITDA ratio, so on and so forth. And I can say that it's very popular. 85% of equity research are based on multiples. And the second, more than 50% of all merger acquisition valuations are based on multiples as well. And rule of thumb based on multiples are not only common but are often the basis for final valuation judgments. So when top management talk about certain investment decisions, of course they will look at cash flow based models, but before they make the final call, they look at the valuation multiples such as P ratio. And relative valuation can also be used in determining the terminal value. We covered this during the last week. We talked about terminal value. Of course, we can use constant growth model. And other than that, we can also use multiples to get an estimated terminal value. So relative valuation is pretty popular, not only among amateurs, but also among professionals as well. Now let's take a look at a big picture of many different valuation multiples. And valuation multiples showed us, first of all, what we are paying for the stock, and the second, what we are getting in return. So it's the ratio of what we are paying and what we are getting. Then we have different measures for what we are paying as well as what we are getting. On the numerator, that's what we are going to pay for the stock, and typically the stock price or market value of equity. And we have two alternative measures of what we are paying. The first one is value of the firm. And the value of firm is the sum of stock value plus debt value. And another popular numerator that we use is so-called enterprise value. Enterprise value equals equity value and debt value and minus cash. That's the enterprise value. On the denominator, we look at what we are going to get when we once we purchase stock, or what we are getting from purchasing stock. Well, what we are getting can be measured by following 4 different items. Most popular one is earnings. Of course, we buy stock because we are expecting dividend to be paid, and the source of dividend is earnings. So earnings are very important measurement of what we are getting. And here we can use net income as measure of earnings, such as, for example, in P ratio, we use EPS, earning per share, as denominator to show what we are getting from a company. Or we can use EBIT, operating income, or EBITDA, earnings before interest, taxes, depreciation, amortization. So that is earnings. Other than earnings, we can use cash flow. Cash flow to the equity, free cash flow to the equity, and a free cash flow to the firm. And both cash flow can be utilized to show what we are getting in return from owning a stock. And the third one is book value. It could be book value of the equity, or it could be the book value of the firm, or even invested capital. If it's a book value of the equity, that is the sum of book value of debt and the book value of equity. And be careful when you talk about book value of debt. That is book value of its long-term debt. And invested capital, including book value of long-term debt and book value of equity minus its cash holding. That is essentially the enterprise value. But it's on the book. And the last one is revenue. And you can make denominator as revenue of the company. Other than revenue, you can use sector specific variables such as number of customers, number of subscribers, number of clicks if it's an information technology company and so on. So this shows you a big picture of many different valuation multiples. No matter what kind of multiples you are talking about, we are essentially getting the ratio of what we are paying and what we are getting. So is a multiple higher a better thing or worse thing? Of course, you want a low multiple. Low multiple may indicate that asset is undervalued and you might getting a good deal because you pay less to get the same thing. You pay less for getting the same thing. So lower multiple typically means it's a good thing. It might indicate a worthwhile investment. It might indicate undervalued assets, and a high multiple, generally speaking, indicates that you may not the assets could be overvalued. But it really depends because different multiples have different drivers, and at a certain time, in certain companies they might have high P ratio, but this high P ratio could be justified by high growth rates, so on and so forth. So on the one hand, you look at this ratio. On the other hand, you look at the drivers of those ratio. You look at if the current ratio is justified by those valuation drivers. And we will get into this a little bit later to see the fundamentals of valuation multiples. Okay, this chapter is about price earnings ratio or PE ratio. What is P? P is stock price. What is E? E is earnings. And typically we use stock price divided by earnings per share to get a PE ratio. And this P ratio could be very confusing because it really depends on what stock price you are using and what EPS you are using. If you go to Yahoo Finance and to find a P ratio of company, it's very likely that P ratio is outdated. Why is that? Although stock price is the current stock price, however, the EPS could be the EPS in the most recent financial years. And right now, we are in April of year 2020, right? Early April year 2020. So, based on Yahoo Finance, when you see a P ratio equals 12, you assume that the earnings that you're using this P ratio is earnings in year 2020, but actually it's not. It is not. It could be the earnings in year 2018. Why is that? Because in early April, some company may not release their year 2019 results yet. If year 2019 results is not ready yet, then the only number that is available is year 2018, which is like a 2 years old. So you really need to pay attention to this EPS. And the best P ratio for you to utilize is the one based on the EPS in the current year, or the EPS for the next 12 months. And the EPS for next 12 months hasn't been reported. It hasn't happened yet, and typically it's based on financial analysts' estimates or forecasting. So that is called a forward P ratio, which is based on future earnings. Right? And forward P ratio is more indicative of its value. And what you can see on a lot of websites is outdated P ratio. It could be P ratio based on last year's earnings, or even earnings in like 2 years ago. So be careful about this P ratio, right? And if it's based on past EPS, it's called trading P ratio. It could be EPS in the most recent financial year, or it could be EPS in the last 12 months if you are calculating EPS based on quarterly reports. So be careful about this P ratio to see what earnings that you're using. And the P ratio has a lot of drawbacks. First of all, earnings could be volatile. In that case, P ratio can be a biased valuation measure. And second, P ratio is subject to managerial manipulation of accounting numbers, because it's based on earnings, but earnings can be manipulated by using a lot of methods from management perspective. So if earnings are not a reliable number, then this P ratio would be misleading. For the company that acquire other company to generate the growth, this P ratio, the past P ratio tend to be a very misleading indicator of the future valuation. And also you need to consider its diluted effect on earnings, such as diluted earnings based on stock and option compensation of the management or employees. So this P ratio do have some drawbacks, but it's a very popular way for people to get a very intuitive sense on its relative valuation. Now let's take a look at the distribution of P ratio. What's a reasonable P ratio? In year 2015, we compare about 8,000 US based companies to see what their P ratios are. And here you see a normal distribution of P ratio, but it's not standardized normal distribution. It's skewed to the left. And you see most companies have P ratios between 12 to 20. That's considered to be a reasonable range of P ratio. But many other companies may have extremely high P ratio, 20, 30, 40, 50, or even higher than 100, as you see from this picture, as well as some companies that has extremely low P ratio, right? And this table showed you distribution of P ratio back to year 2015 in US, and total number of company that we are doing comparison is about 8,000. As you see, more than 50% of companies do not even have P ratio. Why is that? Because earnings may be zero or earnings could be negative. In that case, P ratio would be meaningless. And we only have less than 50% of companies that do have P ratio, right? A little over 3,000. And the average P ratio is pretty high. The current P ratio is about 72, and trailing P ratio 60. Why average P ratio is high? Because we have a lot of outliers. May have P ratios such as 5,000, 10,000. Why does the company have such a high P ratio? Just because this company have really low earnings. Really low earnings. For companies that has really low earnings, you might have a very high P ratio. And in this case, median would be a better indicator of the average if you have a lot outliers, and median, yeah. And here you see the median of P ratio is about 20. No matter which P ratio they're using, current P ratio, trailing P ratio, or forward P ratio. Current P ratio 20, trailing P ratio 19.74, and forward P ratio 18.32. So it's in the upper range of 12, between 12 and 20. I mean, as I said, 12 to 20 is a reasonable P ratio. And right now, in year 2015, the stock market is in the bull market shape, and the valuation is pretty rich. And that's why you see the median P ratio is in the upper part of that range. And the maximum, I mean, it could be like a 23,000. For the P ratio 5,000. Those are outliers which will affect the average a lot, but it won't have a lot huge effect on the median. So median would be a better indicator of so-called average. Now let's take a look at the global P ratio distribution. And in this picture, you see that in the U.S., median is 19.74. Then you compare U.S. versus Europe, Japan, and other areas, including emerging markets. You find that the U.S. market has a relatively high P ratio, and in Japan is 14. Emerging markets is about 16, and the global average is about 16. But the U.S. has higher than average, 19.74. That's year 2015. So in year 2015. Relatively speaking, U.S. market has rich valuation relative to other markets around the world. Okay, P ratio equals price to earnings, right? And some company have high P ratio, some company has low P ratio, but generally speaking, high P ratio indicates company may be overestimated. But here you need to be really careful making this statement. High P ratio, does high P ratio necessarily mean high valuation or overvaluation? High valuation is different from overvaluation, right? And so we need to look at the drivers of P ratio. I mean, some companies do have high P ratios, such as Google. They have a high P ratio of 35 relative to Microsoft, which is about 15. Why is that? Because Google may have greater potential for growth. So high P ratio in Google can be justified through its high growth rate, and growth is one of the drivers. So we want to look at the drivers of this P ratio. And here you see a very simple mathematical manipulation. We are decomposing stock price and decomposing this P ratio. And the P ratio can be expressed in a combination of 1, 2, 3 factors. The first one is payout ratio, the percentage money that the company distributes to shareholders as dividend or stock buybacks from its net income. And the second factor is the growth rate, G, and the third one is required rate of return. So this P ratio has something to do with the payout ratio, the growth rate, and the required rate of return, or the interest rate. Three main factors. And the most sensitive factor here is the G. The company has high growth rate, deserve high P ratio. And sometimes you find a company has a low P ratio. You might think this could be a great opportunity for you to capture an undervalued stock, but those companies may have shown a low growth rate or even negative growth rate. And when you have low P ratio, doesn't mean stock price will increase in the future. And if you capture a falling angel, then the low P ratio will lead to even lower stock prices. And that's called a value trap. From P ratio, you thought it's undervalued, but actually it's not, because this company is going to have negative growth, and the stock price will continue to decline. That's called a value trap. And the previous formula is based on one stage model, assuming constant growth rate. But for most companies, you would say, hey, it's more reasonable to use two-stage model, where company may have high growth rate next 5, 6, 7 years, and then you have constant growth time period. If you use two-stage model, then we can decompose this P ratio into a very complex combination of 1, 2, 3, 4, 5, 6. Actually, yeah, as many as 6 factors. They are payout ratio during a high growth time period, the growth rates during a high growth time period, as well as the required rate of return on cost of equity during a high growth time period. And the 3 other factors are payout ratio during a stable time period, the growth rate during a stable time period, as well as cost of equity during a stable time period. So this equation is pretty complicated. You don't like it, I don't like it, but you can use this equation to get estimated P ratio of a company based on its business fundamentals. So what are business fundamentals? Payout ratio, the growth rate, and the cost of equity. Those are 3 business fundamentals that can determine its PE ratio. Right? Don't worry about this equation, and I developed a P ratio calculator based on this two-stage model. If not well, feel free to use it for your second exam, because several questions may ask you to calculate the P ratio based on its business fundamentals. Not based on stock price or earnings, but based on business fundamentals. And from there, you will see a more reasonable estimation of P ratio. What's the realistically estimated P ratio? Right? Then you can compare this estimated P ratio with the current P ratio to see if it's overvalued or undervalued. Right? Let's say a company has current P ratio of 20, but when you look at those 3 critical factors and put it into equation, and you say, hey, the P ratio should be a little higher than that, and so therefore the current stock price could be undervalued. That's the determinants of P ratio based on two-stage model. Now here's an example. For you to get so-called fundamental P ratio based on three major drivers of P ratio: growth rate, payout ratio, as well as cost of equity. And here, growth rates, payout ratios are different. Make sure you understand that those 2 variables are different in high growth time period and in stable growth time period. And also, beta could be different. Although in this case it's the same, but it could be different because company may have higher beta in high growth time period than the stable growth time period. So make sure you capture the differences in those 3 variables and put 3 variables into your pretty complicated equation. But I have P ratio calculator for you to utilize. Don't worry about that. Just that you need to put that into your Excel spreadsheet to fix some second exam problems. So as I said, there are three key drivers: the growth rate, the payout ratio, and the cost of equity. And P ratio is very sensitive to, first of all, the growth rate. And this picture shows you the impact of growth rates on its P ratio. When a company has a low growth rate, such as, for example, 5% growth rate, you see the P ratio is in the range of 20-30. But when growth rate increases to 25% or even 30%, the P ratio will increase dramatically towards the level of 70, 80, or even more than 100. And if growth rate is 50%, 200 P ratio would be justified. And here you have four different four different colors in those bars, and those show you the P ratio based on different interest rates. And the blue one is showing you the P ratio given 4% interest rate, and the yellow one, the yellow one is the one where interest rate is equal to 8%, and the green one is the one where interest rate equals 10%. You see, inverse relationship between P ratio and the interest rate. Higher interest rates depress P ratio, and P ratio tend to be higher when interest rates are lower. So here you have two basic relationships. High growth means high P ratio, and this is a very sensitive factor. Very sensitive factor. Right? If you want to get a reasonable estimation of P ratio, it's better to have a reasonable estimation of its growth. Growth is very sensitive to P ratio. And the second factor is the interest rate or cost of equity that you use to discount future cash flows in your valuation. And higher interest rates, of course, means lower stock price and lower P ratio. Right? So it's a positive relationship between growth and P ratio, and a negative relationship between interest rates and P ratio. And the third factor here is the risk, and as you see, higher beta lead to lower P ratio. Right? So in your equation, you don't see beta. Where's beta? Well, beta is hidden in this cost of equity. Right? The company that has higher beta will have a higher cost of equity, therefore lower P ratio. So this risk is embedded in cost of equity. And the higher risk means lower P ratio, because investors require higher return if they bear more risk, and if the investor has higher required rate of return, their stock price is going to be lower, which will be translated into lower P ratios. And here I have one method for you to utilize to estimate a reasonable P ratio, which is based on regression, and this is a cross-sectional regression. You compare one company with main competitor to see if this company has a reasonable P ratio or not. And here we look at the relationship between P ratio and three other key factors. The first one is the growth, the interest rate. Second one is the growth. The third one is other risk. And this is for cross-sectional analysis between different countries. And in this table, you see we have many countries in this analysis: Argentina, Brazil, Chile, Hong Kong, so on and so forth. And on the first row, you see the current P ratio of the market. On the second row, that is the interest rates in different countries. And the third row shows you the GDP real growth in those countries. And the fourth column shows you the country risk from different markets. And we run regression between P ratios and those three different determinants. And once we get this regression results, then we can plug numbers into this regression formula to see what is a reasonable P ratio or predict the P ratio. For example, for Argentina, if we apply this regression, and regression will show that the reasonable P ratio or projected P ratio will be 13.57, but the current P ratio is 14, which means the Argentina market is slightly overvalued. Slightly overvalued. Do you see any market that is undervalued? Well, for Hong Kong, predict the P ratio 23. Predict means, okay, it's P ratio based on business fundamentals. It deserves to have 23 P ratio. However, kind of P ratio is 20, which means Hong Kong market may be significantly undervalued at this point. And for India, it's undervalued. Indonesia, it's about fairly valued because current P ratio 15, but the projected P ratio 15.09, so it's about the same. So you can see Indonesia market is fairly valued, and Malaysia undervalued. Do you see any overvalued markets? Singapore 24, slightly overvalued, although its reasonable P ratio is 23. So this regression model, this regression method give you a great opportunity to see if a company is overvalued or undervalued relative to its business fundamentals. Now let's take a look at a P ratio across the time. And previously we do cross-sectional analysis. That's the analysis at the same time, but for different markets or for different stocks. But sometimes you want to look at a time trend of P ratio. And what I can say here is P ratio actually changes over time. And P ratios actually have something to do with interest rates, willingness to take risk or risk preferences of the investors, expected growth in earnings, as well as ROE. And then we have three factors have positive relationship with P ratio over time. That is willingness to take risk, expected growth, as well as ROE. ROE measures the operating performance. High growth means high P ratio, better operating performance means high P ratio. And if investors are willing to take more risk, of course, stock price may be overvalued, therefore P ratio could be higher. And the interest rate has negative effect on P ratio. When we have high interest rates, then P ratio tends to be lower. But when we have low interest rates, P ratio tends to be higher. That explains why currently we have high P ratio on the market, because interest rates are pretty low since the most recent financial crisis in year 2008, year 2009. Because since then, the Central Bank of the U.S. actually maintain a very low interest rate environment for the economy. That's why you see pretty high P ratio, because of the low interest rate environment we are living in. This picture shows you the P ratio over time for S&P 500, and it's from 1969 to year 2015. And typically you see this P ratio in the range of 10 to 20. That's a pretty reasonable range of P ratio. But it could go very high to 30, 40, such as in year 1999, year 2000. P ratio of S&P 500 has go as high as 40. That indicates asset bubble, and that is caused by dot-com bubble in year 2000. Yeah, and when dot-com bubble bust in year 2001, year 2002, P ratio actually go down to a reasonable range, which is between 15 to 20. So a P ratio between 15-20, you would say it's a reasonably priced market or reasonably priced stock. But still, you look at the fundamentals P ratio, and right now we have relatively high P ratio around 20. That doesn't mean the time market is overvalued, because right now we have pretty strong economic growth. We have pretty good operating results from S&P 500 companies, and the low interest rate. When you have a combination of low interest rates and strong growth of of companies' operating results, then it will be translating to high P ratio. Now let's take a look at the inverse of P ratio, that is EP ratio. EP ratio. And the EP ratio is a term used by Federal Reserve of the US. And here you can see EP ratio can be regressed against the T-bond rate and the TBL rate. And actually, EP ratio reveals the return on the stock market. And often we compare EP ratio with bond market return to see which one's higher. So if EP ratio is higher than bond market, that means bond market is more attractive. But when EP ratio getting close to bond rate or lower than bond rate, it might indicate that equity market could be underestimated. But here we can regress EP ratio against some interest rates such as T-bond rate and the TBL rate. And also we see significant relationship between EP ratio against T-bond rate, TBL rate, not only before year 2014 but also for year 2008. Anyway, this relationship actually varies. You see coefficient estimate is different if you use different time period or different data sets. But the reliableness of the regression is pretty high, reflecting high R-squares around 50%. As I said, the growth rate is the most sensitive factor to P ratio. When you need to compare P ratio between two different companies, you need to be careful because those two companies may have different growth rates. And if you wanted to compare companies operating in different industries, and this G is extremely important factor for you to consider. Certain industries may have high P ratio overall than the other one, and the most important reason behind that is because certain industries may have high growth rates than the others. So some investors really wanted to compare P ratio between companies that have different growth rates or industries that have different growth rates. So if that is the case, then we needed to develop a new ratio called PG ratio, which divides this P ratio with expected growth in EPS. It's the P ratio controlled by the growth rates. So is lower P ratio better or higher P ratio better? The answer is lower. Lower P ratio means, lower PEG ratio means it might be a good opportunity for you to capture a undervalued asset because this PG ratio already controls the effect of the growth rate. So that's the PEG ratio. So when you do a financial analysis, when you look at the P ratio of a company, it's better for you to look at its PEG ratios as well when you do historical comparison or peer comparison. Because different companies or even the same company during different time periods may have different growth rates. And the PEG ratio can reflect its relative value when you control the effect of growth. And regarding the factor that affects the PEG ratio, I would say most important factors are risk and payouts. The company that is more risky will have low PEG ratio, and the company that have high payout ratio may have high PEG ratio. So that concludes chapter of 18. Pretty straightforward chapter, P ratio. And here I want you to focus on fundamental PEG ratio when you do a valuation project, and also want you to do a little work using regression methods, using this fundamental PE ratio determinant. What is the realistic or reasonable estimates on P ratio of the company. So that's PE ratio. I hope you enjoyed this video. We are in the 4th week of the study. Once again, I urge you to I worked really hard on 3 chapters that we are going to cover this week, and work on a second exam is due next week, as well as the financial analysis that you need to do in your valuation project. I hope you enjoyed this video, and I will see you very soon. Thank you so very much.